It is the final trading day of the second quarter and the first half of the year. The stock market at a record high, opening higher in today's session. Fractional gains across the board. The S&P up just about 0.3%. And joining me now with more is Eddie Ghabour. He's a co-founder and CEO at Key Advisors Wealth Management. Eddie, always great to have you on the show, especially as we look to round out the first half of the year. How does the market look to you?
The market looks extremely strong right now. And the momentum and trends are definitely to the upside. And what a tale of two stories we've seen so far this year, where the lows of the lows in April, and now here we are, have had a massive V-shaped recovery. And the interesting thing is, it's like the higher the market gets, the more hated and the more doubters there are out there. And we believe that this negative sentiment that we continue to see is just going to fuel this market to new highs and continuing to break new highs. So we are very optimistic that there's still a tremendous amount of upside over the next 12 months. It won't be in a straight line, but you cannot fight the tape. And right now, it's about as bullish as an investor could want to see.
Interesting. Okay, so there do still seem to be worries out there, Eddie, namely whether or not this tax bill and spending cuts plan is going to pass. The president wants a July 4th deadline on that. Of course, tariffs, how those trade deals come together, and the Fed. So how do these factor in to a bullish case?
So, let's take a look at the Fed. I don't think there's any doubt now that we're closer to a rate cut than not. We've seen some softening data in real estate and things like that, but there's a big difference between a softening data and going into a recession. So we look at the Fed as a bullish catalyst that we may now get 2 cuts this year, which we were pricing in just a couple of weeks ago. On to the tariffs. I don't think the market cares anymore, in the sense that we haven't got this huge spike in inflation that everybody feared on the tariff side. And maybe it's because we're more of a service-driven economy. But at the end of the day, I think this administration is going to get these trade deals done because they know it's critical for their re-election hopes going into next year during the midterms. And in regards to this bill, whether it happens on the 4th or not, I'm not sure. I don't think anyone knows. It looks like that we are closer to getting it passed than I thought. I thought we would have to wait till August. But when you look at those 3 things, it's not a matter of if, it's when they all happen. So we're going to get a rate cut this year, in our opinion. We're going to get the trade deals done, in our opinion. And this bill will pass in some form or fashion. And all 3 of those things, again, are bullish catalysts. And the more people doubt those 3 things, the more bullish the tape is going to get, in our opinion.
Okay, so are you anticipating broad-based gains? Eddie, is that the thesis here of your bullish case?
Yes, we think you're going to see it start to really broaden out once we get through the summer. We should expect some volatility as we go into July and August because of the big move we've had, because of the data and the back and forth we're going to get on those 3 items. But I think the pullbacks will be very controlled because so many people were caught off sides. They're going to be forced to buy, and we've seen that. And I do think you're going to see the broadening out, which is why we have done that as well, too, in our portfolios.
Interesting. Technology, I know, at least coming into the year, was a big focus for you, Eddie. Do you think those technology names can continue to lead this rally higher?
I do, and it's hard to get away from the tech trade because when you look at it mathematically, they have such a large percentage component to the broad indexes that it's almost impossible for the Mag 7, or at least a majority of them, to continue to be leaders in this market go up. So we definitely have a tilt towards tech. We're glad we came into this year this way, and it's really paid off handsomely.
Yeah. In terms of cryptocurrency, that's something that I want to focus on. We see Bitcoin little change today, gold up just about 0.1%. I know gold is a specific asset that you have been bullish on. Are you still bullish on gold even as the stock market sets new record highs?
We are, and gold underperformed here over the last couple of weeks. We think right now it's probably oversold and another good buying opportunity. We may actually add more gold today because we think the trend for gold is going to continue to go higher. And the gold thesis for us is It is a defensive asset class that we think is going to beat bonds. Bonds has been an area that a lot of investors have put money in for stability part of their portfolio, and they have just really underperformed. So we're looking at gold as a defensive part of our strategy, and so far it has worked out very well. Even with a little bit of a pullback this year, it's just, again, off to another fantastic start.
So how does cryptocurrency factor into that? I think up until the recent pullback that we had seen during that volatile stretch, though markets are at a record high, many had noted that cryptocurrency, Bitcoin, for instance, was heavily correlated to these technology names. We've seen it kind of take different forms the past few months or so. Is that something that looks attractive to you?
It is. Actually, for the first time, we bought a Bitcoin ETF, Fidelity's Bitcoin ETF, that we put into our portfolios in the month of June. And one of the main reasons why is as we try to broaden out our portfolio, we also look at correlations and volatility. And the interesting thing, to your point, is we have seen Bitcoin's correlation to the NASDAQ not be as closely tied to it. And we've actually seen the volatility come down tremendously. So we looked at Bitcoin as an area that could beat the S&P, but also maybe even lower the volatility of our total portfolio. Just to the way that the market action has been in Bitcoin. So as long as that trend continues, I think you're going to see more and more money flows from investment firms like us adding to that, and that should fuel more upside. And if that correlation changes again to the negative, we'll get out of it. But right now, we really like it, and that would be a spot we would be adding as well on any dips.
Okay, so bullish across the board. I'm now bullish on Bitcoin too. Still staying strong on gold. Anything other than perhaps bonds that maybe doesn't look attractive to you?
So we don't like healthcare right now. Healthcare we've stayed away from. Consumer staples we have stayed away from in our tactical strategies. And definitely some retail names that continue to struggle. So, you want to be concentrated in the areas that are going to be most bullish in a higher risk economic regime type of scenario that we're in right now. And that's why you're seeing those low beta plays really underperform. And we think that will continue. So we've stayed away from those areas and focusing on the areas that we think are going to have more upside, considering how bullish the setup is. All
right, Eddie Ghabour, co-founder and CEO at Key Advisors Wealth Management. Eddie, thanks as always.
Thank you.